Welcome, everyone. Today, we are going to explore one of the most powerful tools that traders have, the volume indicator. By understanding how to use volume, you can gain valuable insight into market trends and price movements. By the end of this discussion, you will understand exactly how to read and apply the volume indicator so you can make smarter trading decisions. Stay tuned because we have a lot of great stuff ahead that will help you gain confidence in your trading journey. Before we dive in, imagine being able to understand the heartbeat of the market. That is what the volume indicator allows you to do. It acts as a window into the level of activity, showing you just how much buying or selling is happening at any given time. First things first, what exactly is the volume indicator? Think of it as the tool that shows you the level of activity in the market. It tells you how many shares or contracts were traded during a specific period of time. In simple words, volume measures the number of people who are buying or selling. High volume means a lot of people are interested, while low volume means fewer people are active in the market. Understanding the level of activity helps us figure out whether a price move is strong or weak. If the price goes up or down with a lot of volume, that means there is strong interest. But if the price moves with little volume, it could mean that the move is not as reliable. Chart patterns are an important part of understanding volume, as they can give us visual cues about market behavior. Some common chart patterns include the head and shoulders, double tops and bottoms, flags, pennants, and triangles. Each of these patterns tells us something different about the potential future movement of the price. For example, a head and shoulders pattern can signal that a trend is about to reverse, especially if accompanied by high volume at key points. Similarly, double tops or bottoms show that the price has tested a certain level twice, and volume spikes at these levels can indicate whether the trend is likely to reverse or continue. Flags and pennants are continuation patterns that can be very helpful when paired with volume analysis. A flag forms when there is a sharp price movement followed by a consolidation period that looks like a small rectangle, while a pennant forms a small symmetrical triangle. In both cases, if the breakout from these patterns happens with high volume, it is likely that the trend will continue in the same direction. On the other hand, if the breakout happens with low volume, it may mean that the move is weak and could fail. Triangles like ascending, descending, and symmetrical triangles are also very useful to watch. These patterns show a period of consolidation before the price makes a decisive move. When the price breaks out of a triangle pattern with high volume, it often indicates the start of a strong new trend. For example, in an ascending triangle, the price makes higher lows while facing resistance at a certain level. A breakout above this resistance with high volume suggests that buyers are gaining control and that the price will likely continue to move higher. Using these chart patterns along with volume analysis can give traders a clearer picture of what is happening in the market. Volume adds context to these patterns, helping us determine whether a move is likely to succeed or fail. Always pay attention to both the price action and the volume, especially when identifying and trading chart patterns. Now let us get into how we actually read the volume indicator. When the volume increases and the price moves higher, it means that the trend is strong and that the buyers are enthusiastic. It is like seeing a group of people cheering at a sports game. The more people cheering, the more exciting the game seems. In trading, when volume is high, it tells us that a lot of people are interested and that the trend has strength. But what if the price is rising and the volume is not keeping up? That may suggest that the move is weaker and it could mean that we might see the trend reverse soon or that the price will stay at the same level for a while. Similarly, if you see a price drop along with rising volume, that is a sign of strong selling pressure, which means that the downward trend is likely to continue. In those situations, it is wise to be careful before buying. Let us talk a bit about volume spikes. You might be wondering what exactly a volume spike is. A volume spike happens when there is a sudden jump in trading activity. Imagine the crowd at the sports game suddenly getting louder because of an exciting moment. In the market, a volume spike can happen during big news events or earnings reports. When you see a volume spike during a price breakout, it usually means that the move is going to continue in that direction. However, if you see a volume spike without much price movement, it may suggest that traders are unsure, and that could mean a possible reversal is coming. So always pay attention to those sudden increases in volume. Let us also discuss how volume spikes can be linked with specific chart patterns to provide further insight. For example, when you see a head and shoulders pattern forming, a volume spike during the second shoulder or as the price breaks below the neckline can strongly confirm that a reversal is happening. In double tops or double bottoms, volume spikes near the top or bottom levels can indicate whether a reversal is imminent or if the level will hold. The greater the volume during these key moments, the more likely the pattern is to play out. Volume spikes also play a crucial role in flag and pennant formations. During the initial sharp price move that forms the flagpole, a volume spike usually confirms that there is strong momentum behind the move. During the consolidation phase, volume tends to decrease, but when the price breaks out of the flag or pennant, a renewed spike in volume suggests that the trend is ready to continue. Low volume breakouts, on the other hand, are less trustworthy and may result in a failed breakout. In the case of triangle patterns, volume spikes are also essential. In an ascending triangle, for instance, if the price breaks above resistance with a sudden increase in volume, it signals that the buyers have taken control and that the uptrend will continue. A similar principle applies to descending triangles, where a spike in volume as the price breaks below support suggests that sellers are firmly in control, making the continuation of the downtrend more likely. Understanding these relationships between volume, spikes, and chart patterns can help traders make more informed decisions. Let us take a closer look at some of these chart patterns to expand on their significance and how volume can further enhance their predictive power. Head and shoulders patterns are one of the most well-known reversal patterns. This pattern consists of three peaks, with the middle peak being the highest, forming the head, and the other two peaks on either side, forming the shoulders. Volume plays an essential role in validating this pattern. During the formation of the left shoulder, volume often increases, showing buyer interest. As the head forms, volume may start to decline, suggesting that buyers are losing momentum. The right shoulder should see even lower volume, which shows weakening buying interest. A significant spike in volume as the price breaks below the neckline confirms the reversal, signaling strong selling pressure and indicating a potential downtrend. Double tops and double bottoms are also key reversal patterns that traders rely on. A double top is formed when the price reaches a resistance level twice and fails to break through. Volume analysis is critical here. During the first top, volume tends to be higher, while the second top usually forms on lower volume, suggesting that the buying pressure is diminishing. A spike in volume as the price falls below the support level between the two tops confirms that the reversal is genuine. Similarly, for double bottoms, volume should ideally increase during the rallies from each bottom, and a strong spike in volume as the price breaks above the resistance between the two bottoms confirms the trend reversal to the upside. Flags and pennants are continuation patterns that occur after a sharp price movement, known as the flagpole. A flag resembles a small rectangle that slopes against the prevailing trend, while a pennant resembles a small symmetrical triangle. These patterns represent brief consolidation before the trend resumes. Volume typically decreases during the formation of the flag or pennant, reflecting a temporary pause in activity. When the breakout occurs, a significant increase in volume is essential to confirm that the prior trend is resuming. If volume remains low during the breakout, the move may lack strength and could potentially fail. Triangle patterns, such as ascending, descending, and symmetrical triangles, represent consolidation before a major price move. In ascending triangles, the price makes higher lows while consistently testing a resistance level. Volume generally decreases as the pattern forms, indicating consolidation. A breakout above the resistance level with high volume signals that buyers are gaining control, and the price is likely to continue upward. In descending triangles, lower highs are formed while the price tests a support level. A volume spike during a breakdown below the support level confirms strong selling interest, suggesting that the downtrend will likely continue. Symmetrical triangles, which form when there are both lower highs and higher lows, show indecision in the market. A breakout in either direction with strong volume provides confirmation of the new trend direction. Rising and falling wedges are additional patterns that traders should understand. A rising wedge forms when the price makes higher highs and higher lows, but the trend lines are converging. This pattern often suggests a potential reversal to the downside. Volume typically declines as the wedge forms, showing that buying interest is waning. A spike in volume during a breakdown from the wedge signals that sellers are gaining strength and that a downtrend is likely. Conversely, a falling wedge forms when the price makes lower highs and lower lows, with trend lanes converging. This pattern often indicates a reversal to the upside. Declining volume during the wedge formation, followed by a volume spike during the breakout, confirms that buyers are stepping in and that the trend is reversing upward. Using volume analysis with these chart patterns adds a powerful layer of confirmation. It helps distinguish between strong and weak moves, thereby improving the accuracy of trade entries and exits. Always remember that volume spikes are not just random noise. They are the market telling you where the interest is strongest. Use this knowledge to confirm key patterns and improve your confidence when entering or exiting trades. Volume is also very useful for confirming trends. Let us say we are in an uptrend and the price keeps going higher while volume is increasing. This is a sign that the trend is strong and that it is likely to continue. On the other hand, if volume starts to drop while the price is rising, it might mean that buyers are losing interest and we could be nearing a reversal. In a downtrend, increasing volume confirms that there is strong selling pressure. If the volume starts to decrease, it could mean that the sellers are stepping back and the downtrend may be getting weaker. Now, let us move on to evaluating breakouts. When the price breaks through a key level, like a level of resistance or support, the volume can tell us whether the move is real or not. If the breakout happens with a lot of volume, it is a good sign that the move is real and that the price is likely to keep going in that direction. But if the breakout happens with low volume, it could mean that the move is false and that the price might end up going back into its previous range. Always remember to use volume as a way to confirm those major moves. One of the most exciting things to look for when using volume is spotting reversals. A reversal happens when the price changes direction. When the price hits a key level, like a support or resistance level, and you notice a spike in volume, that could be a signal that the price is about to reverse. This is especially true if the price starts to stall or change direction right after reaching that level. If the price keeps going up while volume is dropping, it may be a sign that the trend is losing strength and that a reversal is on the way. Let us talk about some practical ways to use volume in your trading. The first thing you can do is use volume to confirm trends. If you see the price moving higher and volume is also increasing, you can feel more confident that the trend is strong. This means that buyers are committed, and it suggests that the uptrend has momentum. However, if the volume starts to decrease while the price is still moving up, it may be an early warning sign that the trend is weakening. In this situation, you might want to tighten your stop losses or get ready for a possible reversal. Another powerful strategy is to trade breakouts by looking for price moves that break through key levels with strong volume. Breakouts can occur when the price breaks above resistance or falls below support. When volume supports the breakout, it means that there is strong participation in the move, making it more likely to be sustained. For example, if the price breaks above a key resistance level with a noticeable increase in volume, it is often a good idea to enter a trade in that direction because the move has strength behind it. On the other hand, if a breakout occurs with low volume, it might be a false breakout, and you should be cautious. Finally, you can use volume to spot reversals. Reversal trading can be very profitable if done correctly. If you notice high volume at a key support or resistance level and the price changes direction, it could be a good opportunity to enter a trade in the new direction. For instance, if the price approaches a resistance level and you see a spike in volume followed by a sharp reversal, it indicates that sellers have stepped in forcefully. This volume spike is a clear signal that the market sentiment has shifted, and it could be a good time to go short. Similarly, if the price hits a support level with a volume spike and starts to move upward, it could mean that buyers are taking control, and it might be a good opportunity to go long. Another pattern to consider when using volume for reversals is the divergence between price and volume. For example, if the price is making higher highs but volume is decreasing, it suggests that fewer traders are participating in the uptrend and a reversal may be on the horizon. The same principle applies during downtrends. If the price is making lower lows but volume is falling, it could mean that sellers are losing interest and a reversal to the upside may be near. Using these volume signals to identify reversals can help you enter trades with good risk to reward ratios, making your trading more effective overall. Now let us discuss some common volume indicators that you might find helpful. One of the most well-known is unbalanced volume, also known as OBV. This indicator adds the volume on up days and subtracts it on down days. It helps us confirm whether a trend is likely to continue. If OBV is rising along with the price, it means that the trend has support and buyers are showing commitment. If OBV starts to decline while the price is still rising, it could be a sign that the trend is losing steam, suggesting that a reversal might be near. Another useful tool is the volume oscillator. This compares the short-term and long-term moving averages of volume to provide insight into market momentum. A positive reading indicates that the short-term volume is higher than the long-term volume, which suggests increasing momentum and a stronger trend. A negative reading, on the other hand, signals weakening momentum, which may indicate that the trend is fading. The volume oscillator can be especially useful in identifying periods when momentum is shifting, helping you make more informed decisions about whether to enter or exit trades. Another helpful indicator is the accumulation distribution line. This indicator tracks the flow of money into or out of an asset by analyzing both price and volume. When the accumulation distribution line is rising, it suggests accumulation, meaning that there is buying pressure and that traders are accumulating shares. This often supports a price increase. Conversely, when the line is falling, it indicates distribution, meaning there is selling pressure and traders are offloading shares. This is a bearish sign and could lead to a decline in price. In addition to these indicators, there are other volume-based tools that can enhance your analysis. For example, the shaky money flow indicator combines price and volume to show the strength of buying and selling pressure over a set period. When the indicator is above zero, it indicates that buying pressure is dominant, whereas a reading below zero suggests that selling pressure is in control. Another tool is the Money Flow Index, or MFI, which is similar to the Relative Strength Index, but incorporates volume into its calculations. The MFI helps identify overbought or oversold conditions, providing a clearer picture of whether the price may be due for a reversal. By using these volume indicators in combination, traders can gain a much better understanding of market trends and price movements. Each of these indicators provides different insights, and when used together, they can help confirm signals and improve the accuracy of your trading decisions. Volume is a critical component of market analysis, and incorporating these tools into your strategy can greatly increase your chances of success. Volume is also very important when it comes to risk management. One way to use volume is to help set your stop losses. When you're trading based on volume, you can place your stop loss just beyond key levels where high volume occurred. This helps protect you from unexpected reversals. You should also think about adjusting your position size based on volume. When volume is high and it supports your trade, you might consider taking a larger position. During times when volume is low, it is often wise to reduce your position size to manage your risk. Low volume can mean that price moves are less predictable and more volatile. Let us also go over some common mistakes that traders make when using volume. The first mistake is ignoring volume during key price moves. You should always check the volume to see if a move is supported. A price move without strong volume may not be reliable and could reverse quickly, especially when trading based on chart patterns such as breakouts or reversals. For instance, a breakout without sufficient volume may indicate a false breakout, and the price could move back into its previous range. Always ensure that volume is confirming the move before acting. Another mistake is reacting too much to small volume spikes. Not every spike in volume means that there is a major shift happening. Make sure to look for confirmation from the price action before making a decision. For example, during a flag or pennant pattern, volume spikes can happen within the consolidation, but it is the breakout volume that is more important for validating the move. Another common mistake is misunderstanding how volume should behave during different chart patterns. For example, during a head and shoulders pattern, volume should generally decrease from the left shoulder to the right shoulder, signaling weakening buying interest. If volume instead increases during the formation of the right shoulder, it may indicate that the pattern is less likely to lead to a reversal. Similarly, during double tops or bottoms, declining volume between the two peaks or troughs often signals that the momentum is slowing down, while a spike in volume as the price breaks key levels is essential for confirmation. Finally, do not rely on volume alone. It is an important tool, but it should be used with other indicators like moving averages or trend lines to get a fuller picture of what is happening in the market. Volume works best when used in conjunction with other analysis methods, such as trend analysis and support or resistance levels, as these additional tools can help confirm what volume is already telling you. Combining volume analysis with other indicators can provide a clearer and more accurate signal for making trading decisions. To wrap things up, the volume indicator is a powerful tool that helps us confirm trends, spot potential breakouts, and identify reversals. When you combine it with price action, you can make much more informed trading decisions. Start by adding the volume indicator to your charts and practice reading how volume moves along with price. Watch for volume spikes during important moves, and always use volume to confirm breakouts or reversals. The more you practice, the better you will get at reading the market using volume. Thanks for sticking with me today. Using volume in your trading strategy can help you understand what is happening in the market and make you a more confident trader. Keep practicing, and soon you will be able to spot strong trades with confidence using volume as your guide. If you have any questions or if there is something you would like to add, feel free to share your thoughts.